Last week, with reference to the US dollar trend, we highlighted how firmly hope has become entrenched in the minds of investors across the globe. This is despite continued strong growth in the global COVID-19 case count, the absence of a vaccine and/or effective treatment regime, and with data only beginning to show the economic consequences of COVID-19. A week on, global markets are holding near their highs, despite evidence of a renewed acceleration in outbreaks across the world. The risks that each nation faces are certainly not equal. Brazil remains in the spotlight as a nation with an out-of-control case count. With around 1.1 million confirmed cases, it is easy to understand why. However, of greater concern for the global economy, the United States has reported twice that number of total cases since the epidemic began, and currently has almost as many new cases as Brazil, as reported by the New York Times and the World Health Organization. On this data, it could even be argued that the new case trajectory the US is facing is worse than Brazil. Of even greater concern for the US is the spread of the virus across its geography. On the New York Times data, 23 states have reported an increase in new cases over the past fortnight, with new cases in another 12 states about the same as the prior period. The significance of this finding is that COVID-19 is not just front and center for a few in the US, but for all. Drilling down into the implications for the US economy, while retail sales surged back in May after a shocking decline in April, this was in large part because households are spending more time at home than out. The risk to the US economy is that the gain in retail sales in May replaces a string of services purchases that would have occurred in the coming months, absent the virus. The greater COVID-19's persistence and spread in the US, the larger the risk to total household spending. Consumption is also at risk in Europe. However, with a much lower level of new cases and a narrower spread across the continent, the greater risk for consumption in Europe is arguably the financial position of households rather than fear of the virus. Very clearly, the past decade has seen a much higher level of unemployment in Europe than the US. Asset returns have also failed to keep pace. This is why it is so important for European government officials to come together to provide additional, meaningful and sustained support for its economy. Relative to the material and probable risks that the US and Europe faces, China's concerns seem negligible. As we outlined previously, China has achieved phase one of a three-phase recovery, the return of production to near capacity and the labour force to work. Ahead is a robust acceleration in investment, and as wealth is replenished and concerns fade, similar gains for household spending. Such an outturn would beget a sharp rally back in GDP, such that year average growth in 2021 should be around 10% with balanced risks. This is in contrast to the 2% or so rebound anticipated for the US and Europe in 2021, arguably with downside risks. To our mind, at this stage, the spate of new cases found in Beijing is not a material concern. This is because, unlike in the US, Chinese authorities are acting swiftly to isolate the spread of the virus. And, in contrast to Europe, China's government is also looking to support their economy by proactively encouraging broad-based, profit-focused investment across the economy. If achieved, this investment will protect activity and income now and over the long term, further mitigating the risks that this nation faces. We'll see you next week.